Hello and welcome to this video where we're talking about margin and gearing in financial spread betting, presented by spreadbettingportal.com. So what is margin? Well, in spread betting terms, it's a margin requirement, and a margin requirement is whenever you make a trade or place a trade, a proportion of your deposit, the amount of money that you're putting into your account when you open it or add to it, is reserved as margin to cover the trade. And you can only trade if you have the required margin to open that trade and keep it open. It is there to protect you. For instance, if the spread betting company simply allowed you to keep making all manner of trades without them having any form of assurance and guarantee that any sort of loss is covered, then you could get into a great deal of trouble. So don't see a margin requirement or the margin that's taken from your deposit as guarantee as a negative. It's most certainly a positive thing, because it does various things. It's there to protect you. It stops you from over trading to a degree, and I'll talk about there is a certain risk involved. Still, obviously you can lose money, but there is a possibility of losing more money, which I'll explain to you in a moment. So it's there to protect you, and it's also there how you really should see it. It's kind of there to make you think more about your trading as well, and take it a bit more seriously. For instance, if you were able to trade all over the place and there was kind of no financial guarantee needed to be placed by you on those, then I'm sure that we would, just sort of human nature, make more trades that were potentially less thought out. So how the margin requirement is calculated is they take your cash balance, so that's the available cash that hasn't been traded, that's on balance, that you've deposited or added to or is available, plus, and this is where it gets interesting, plus any profit or loss from current open trades. So if you have trades open that are losing money, this is and will be deducted from your overall balance live on an ongoing way. In as much as if you have open trades that are profitable, then this positive profit from those trades will be available as part of the calculation of the funds available to trade. This is where it gets interesting. You can, for example, trade not only on the balance that you have in cash, but also from the profit of existing open trades too. So for example, say we had £1,000 in cash balance, and we had some trades that are open that were making £200 in total. The resources that we had in terms of the that could be used as a margin against any other trade to open is actually £1,200, not 1,000, because we have £200 in profit from other live trades. Now, the following would only happen if you were actually over trading, but it is a possibility, and this is kind of where that warning comes in on you see on all the websites, where you can lose more than the amount that you've deposited. And this is how it happens, and this should never ever happen to you, certainly if you follow these videos and are essentially being quite sensible with your trading. But say for instance you have £1,000 in cash balance and that £200 profit leaves us £1,200 resources to trade with, and we trade that. We trade all of it. Then those that £200 in profit that we had that was on live trades obviously is going to fluctuate and does have the potential to disappear, and in fact go in the reverse and turn to a loss. You would then not only be losing the money on those trades, but you would also be owing the broker, the spread betting company, money in terms of you having trades open from resources which are no longer there. So what would happen in that instance is you would get a very urgent call from the spread betting company saying that they need some money from you. And this is essentially what a margin call is that there is not enough funds in your account, either in terms of cash or profit, to cover the trades that you have open. So you have two choices. You can keep the trades open if you deposit more money, or the spread betting company will close the trades at a certain time, usually within hours, probably even sooner, and then you will just owe the money to the broker. Now, granted, spread betting brokers, companies are pretty clever now. In fact, they are very clever, and they would note if there's any risk of that happening, and would contact you way before that there was any risk of that happening. Certainly if they saw that you were overly trading on profit from open trades, you would get a call way before, and they would probably ask for some more money to cover those trades, even though the resources they were calculating against was also including profit from open trades. But they always err on the side of caution anyway, and they would probably call you up. When would this happen? Could it happen? Well, yes, it can happen. Pretty much if you're really stupid and you overtrade. If you keep it sensible and you trade sensibly and you watch these videos and you keep yourself in check, then that would never happen. You would never trade so much of your resources. That would never just ever happen. But it can happen if you're stupid. But you're not stupid, so it won't happen. So how do they calculate it? Well, the margin is essentially a percentage of a position known, depending on which broker you go to or spread betting company you go to, known as a margin factor or a deposit factor. And it varies on the market traded. It also varies on the type of account you have. And it obviously, as we previously explained, it varies on your broker. But overall, they're much of a muchness. They're very similar throughout the industry. And they are expressed as a number, which is your amount per point is multiplied against. So say, for example, we were trading on our fictitious company of XYZ, and XYZ was in one of the US indices. That would have usually a margin factor or a deposit factor of 400 times the amount per point traded. So if we say we're trading XYZ at £10 a point, as an example, which is obviously quite a large amount, you wouldn't be necessarily trading at that level right away, but it would require a margin of £4,000 deducted from your available amount to trade. So that would be deducted from your resources, which your resources being the cash balance plus any profit or loss that you currently have. If you were trading £1 per point, then obviously that would be £400. If you were trading 50p per point, then that would be £200, and so on. So these margin factors vary depending on the account and the spread betting company you use. So what are the dangers in doing that? Well, obviously, other than the ones that we've already explained, placing large point size trades will eat up your balance very quickly. Now, going back to where we're talking about whether you could get a margin call and get into trouble, it need not necessarily be the fact that you're placing lots of trades. It could be the fact that you're using, just a couple of trades, but they're such large point sizes. Say for instance, £10 per point, which is pretty large. They could eat up your balance very quickly. And the problem with those is that they can go wrong as well as right, but they can go wrong. You have to be aware of that very quickly too. And which would result in you losing the amount that you're trading that's down as for the margin that's being used, but also potentially more, certainly if you're using some of the profit from other trades that are open to fund that other trade. So it's important, therefore, to stop yourself from doing that is to obviously keep your point size trades down. Don't sort of go crazy at 10, 20 or 30 odd pounds. You know, keep it sort of initially to pennies. Keep it below £1 to begin with. And know what the margin factor is of the market that you're trading before you trade, because you could be trading and before you know it, you've eaten up a lot of your available resources to trade. And the other thing is, don't rely on live trades which are in profit to fund other trades or to cover negative trades. Don't do it. And the only way that you would be at risk of doing that is if you were over trading to begin with. So the golden rules really are: trade small to begin with, and I would strongly recommend using a demo account for a while. Get used to how the portal works, understand what the margin factors are and the requirements for different markets are. Common golden rules are: only trade with your own money, money that you've earned. Never borrow money to trade. Such a huge no-no. Never borrow money to trade. Only trade using savings. And only trade money you can easily afford to lose. And by that I mean that if you've lost that money, it's not going to impact your way of life at all, or put any aspect of your life at financial risk, or even make it a little bit uncomfortable. You don't want to be in that position, and you should only be trading from savings that you have, and you should only be trading 10% of those savings at most. And another big no-no is do not trade money given to you by someone else, whether it's a friend or a family member. You know, for instance, say you're doing pretty well in your trading, and they can see that you're starting to make some money. Don't accept money from them to trade on their behalf. If they want to do it, if they want to make money from financial spread betting, direct them to your spread betting company and let them open the account, and maybe, you know, show them these videos and guide them and so on, but do not trade on their behalf. It can only end in tears. So gearing and leverage, this kind of moves on from the margin requirement, and how sort of gearing and leverage works is by it allows us to control a huge amount, a huge trade in value with only a small proportion of the money put up front. And obviously this varies from broker to broker, but say we can control 100%, as an example, control 100% of the trade with only 10% of the value of the trade. So for an example, say if we had £1,000, we wanted to control £1,000 worth of a company, or you know, a forex position or anything like that. Remember, in spread betting, we're not actually buying anything. We're just opening a contrary position against our spread betting company. We're not actually buying anything. So but we are controlling in a way that amount, say in this case £1,000, but we're actually only trading £100. So it gives us the ability to control and trade large amounts of trades with smaller amounts of money. Now, this goes again with the risks involved with that. Because of gearing, because of how it works, the gearing of that works in reverse also. So there's the positive where, you know, if it moves up, then that's amplified in the amount that we've placed as a deposit, and that's kind of amplified, and we make money pretty quickly. But also you can lose money very quickly from that same gearing too. And so let's say a trade of £10 per point, and the trade moves the whole market for that company, say, moves by £1, you would have lost £1,000, or if it'd gone positive, you would have won £1,000. And £1 moves can happen pretty quickly. Certainly, if we're looking at the US equity trades, these can move easily, sort of $1, $2, $3, $4 easily within a day, within a few hours. And Forex too can move pretty quickly. So the golden rules there really are: don't place too many trades, and only trade a small amount per point to begin with. You kind of have to earn your chops as a trader, and the best way of doing that is to just sort of learn to trade, as we've previously explained. Use a demo account, and then from using a demo account, when you move to a live trading account, just use pennies. Don't go mad. It's still money. Still gives you the same feeling in terms of trading and the responsibility of that, but it's best to make mistakes with pennies and not pounds. Stick to the UK equities and indices at the beginning. They move a lot slower, and they're not as volatile. They don't have the same liquidity as the US markets do. It allows you to benefit and profit if you do it correctly, of course, but at a slower pace. And certainly if you're working, it allows you to sort of not stress too much whilst you're at work, and be one of those people constantly looking at their account to see if it's going up or down. Don't gamble. Analyze why you're making the trade. You'll be amazed at how many people believe they're trading, whereas in fact all they're doing is gambling. They just essentially might as well be tossing a coin in the air and gambling on that, because essentially that if you're not using analysis, and you don't know why you're entering it, or what profit you expect, or what you're going to do if it goes in your favor, and what you're going to do if it doesn't. You should know all these things before you trade, and if you don't, then you're gambling. So don't forget to come and visit our website, spreadbettingportal.com. Pay us a visit, where we have more training videos. You can read some wonderful articles on trading, and see some of the latest amazing deals from those very spread betting brokers and companies that we're talking about. Come visit us today, spreadbettingportal.com.